quarterly expiration measurements. Quarterly expiration measurements. Interesting piece. It's a new market measure sponsored by the SIBO. Let's see what we got. Market maker. Today is triple witching. It is the quarterly expiration. So we thought it would be fun to take a look and see how much more volatile is quarterly expiration from all other expirations, daily, weekly, monthly, whatever. You know,
how is this day different from all other days, Sazno?
That's right. That's right. Market makers do their best to both. First, to be the counterparty to whatever option position traders wish to take. And then second, to remain as hedged as possible, typically by using long and short to cancel deltas from their option positions. Because of this, in principle, market makers adjusting their option expiration dates might have an outsized impact on supply and demand for shares. Because quarterly option expirations are typically the largest in notional value, today they were talking about 5 trillion, weren't they?
Yeah.
Notional. This, we would expect this
the biggest ever, right?
Yeah, we would expect this to be noticeable. As March quarterly expirations near, has this period been measurably different for the overall market? Has this period of triple witching and then coming up the quarterlies in 2 weeks, has this been noticeably different for the overall market? Like, is there going to be more volatility? What do you think?
From a volatility standpoint, you're going with now, right?
Volatility, market movement, yes.
I'm going to say no, Thomas. I'm going to take a shot. I don't really know.
I didn't really know either. Let's go to the next slide. So we did a study. We used 20 years worth of data in the SPY and the VIX. I think the VIX, the VIX has been around for a little over 20 years, right? Yeah. We considered the SPY daily, weekly, and biweekly moves, both as a raw percentage and as multiples of the VIX derived expected move. So we looked at them basically just raw moves and whatever the expected move was as dictated by VIX. All volatility is just another word for expected move. We contrasted these results from the past 80 quarterly option expiration dates to the overall values. So basically, 20 years, 4 quarterly expirations, 80 different, we had a set of 80 different numbers, okay? Mm-hmm. Let's take a look and see how much difference there was, if there was any difference at all between, whatever, given the size of the moves. We looked at a couple different things here. We looked at overall on moves greater than 1% and overall on moves greater than 2%. All right, first, how many moves overall, one-day moves, are greater than 1%? I was surprised by this, but it's 26% of the moves. 1 week, it's 56% of the moves, and over 2 weeks, talking about moving 1%, it's 70% of the time. So we move around the markets. Mm-hmm. But for option expiration on the quarterly basis, how often was it? A lot more.
Maybe because we have them every month now or something.
No, these are quarterly expirations only.
No, I get that, but maybe because listen, when I first started trading, we only had quarterly expirations, but now that we have an expiration basically daily, basically weekly, basically monthly, maybe they just kind of all blend in because it doesn't seem like it's. I would think I would notice that kind of number.
This is very interesting because it's a little bit. It shows that with a greater than 1% move, you're going to have a much higher percentage on getting into quarterly expirations, which is, by the way, in 2 weeks. So let's talk overall 2% moves. 2% moves happen in the market on a daily, on a one-day basis, 7% of the time, 1 week, 29, and 43% of the time over 2 weeks. 2%, just to give you an idea, is 100 S&P points. That's pretty big. Yeah. And then when you look at OpEx, quarterly OpEx, it goes up. Yeah, it goes up from 7 to 8, from 29 to 35, and from 43 to 60. So there's definitely more volatility around the quarterly expiration cycle. Now,
sure,
because we also measured this in with VIX, does the market adjust for it? And because we're able to do this, of course it does.
Yeah.
Like this isn't, we're not showing you something that's not already priced in, just so you know. Like there's no edge here. This is just to know that there's a little bit more volatility coming right around the corner. So now we take a look at all the overall moves again, just like we did before, but now we look at it versus overall expected, and then just overall, because we didn't look at just every move combined, right? We only looked at plus 1%. I mean, plus
Right.
1 times and 2 times. And then what we see here, which is quite interesting, is that when we take all the moves, there's just a incremental difference. Is it a little bit greater? Sure. Does the difference between 26 and 28 make a difference? Nah. I mean, 27, 29, not really. It's not really something that's necessarily tradable. And when you look at overall 2x expected versus overall versus OPEX expected, the difference is, again, statistically insignificant. So when you take all the numbers combined and you look at it on an expected basis or what actually happened, on the expected basis, it's pretty much spot on, which means that volatility has adjusted, right? If you go back one slide, Beth, just for a second, this is actual, right? So when you look at the actual thing, what happened, there's a big difference between the two. But when you go to the next slide, this is where we use volatility. So no, go to the next slide. So this is what the expected move is. Remember, we measured it versus volatility. So volatility is the expected move. So when you look at it versus expected move, what the research team was trying to show you here is that when you look at expected move, it's correct. When you look at it versus historical moves, it's greater than. So all we're saying is the market does a perfect job of pricing everything. Like every time you think, oh, I found something where there's some edge, no, it's priced perfectly.
Yeah, no, I get it.
Okay, yeah, sometimes that's kind of hard for people, but that's...
No, it is kind of hard. It's a great point to make.
Yeah, expected move is what volatility tells us. That's where we measured against the VIX. The actual move is the first piece that we did. So takeaways, in absolute terms, quarterly expirations did seem to result, that was the first slide, did seem to result in more volatile markets than an average day. But when adjusted for volatility derived expected moves, the difference largely went away. So while quarterly expirations are an active time in the market and they can be good for retail traders from a liquidity perspective, market participants need to be aware of the additional risk and premiums, but they've been adjusted accordingly because the market already knows that. That's how smart markets are.
It's smarter than the average bear.
Yes.